Okay, so we're here with Aya, Gold and Silver, who just released the long-awaited PEA for Boumadine here, and I just hand it over to Benoit, and he will commence the presentation and walkthrough of this amazing document.
Thank you, Gorm. Thank you for inviting us back on your podcast. It's always a pleasure to be with you. This is an important day. It's been 3 years in the making since we started the exploration at Boumadine, and now to come up with the PA that's actionable, that is showing the path to production in the next 4 years. So it's a very, very important day for us. I'll go straight through to the PA overview, which we have here. So the PA is now indicating some really important things. It's showing us that we're heading for 400,000 ounces of gold equivalent over the next 5 years. And really the PA is for 11 years, but we have clear visibility on the next 5 years because it does not include in the PA all the drilling that was done in 2025. And we're going to be doing 360,000 meters of drilling in 2026, 2027. So, of course, the mine plan is going to change. And that's what you're seeing here. That's why we say that there will be, change in the mine plan and in the production level based on the drilling of 2025 and the drilling of 2026, 2027. So that being said, what we have currently is a very, very robust, very strong PEA with a very impressive low initial capex of $446 million. That's very, very impressive. So low initial capex, and the reason is because we'll be producing 3 concentrate, and the low capex also is accompanied by low AISC, so low OPEX. So the operation expenditures are low. For the first 5 years, the actual AISC is $928. For the life of mine, it's $1,000. But as you know, this is extremely low. And when you look at the NAV or NPV, you can call it either way, it's $2.2 billion on a pre-tax basis at the base case of $2,800 and $30 silver. So at the base case, it's 2.2 billion or 1.5 post-tax. However, I have to say that we have not yet done the tax planning and structuring. So this is applying in a very simple way a tax rate. It won't be like this. There's going to be structuring that will be put in place, just completely legal, whereby you can minimize the taxes. But in between here and the pre-tax and the post-tax will be the reality. It's got 1.5 billion post-tax and NPV to capex of 3 to 1, which in our industry is extremely high. So when you look at 5 to 1, that's even rare. The internal rate of return on the base case with the geology of 2024 has an internal rate of return between 47 and 69%, and the paybacks between 2 years and 1 year. So it is a very robust project on the base case with the base case geology. So you have the base case metal price and also, the starting geology. So you can see that this project is going to get even stronger and bigger throughout its life. So what we wanted to show here was really the spot pricing. So at spot, at $4,000 gold and $48 silver, the net present value is between 4.5 and 3 billion. Again, the tax effect is quite important because as you have higher silver and gold price, you have more taxes to pay. The internal rate of return is between 77 and 107. It'll be somewhere in between. The paybacks between 1.2 to 0.7 years. And the NPV to capex ratio is between 7 and 10. So again, even more robust than what we saw on the base case, but very unique, extremely rare. And we'll show you some slides at the end that will position this project as the number one in our industry. The revenue for the period on currently the 11-year mine life is 9.9 billion with an EBITDA 6.2 billion and a cash flow before tax of 5.6 or after tax of 3.8 billion. Now, this is what we really are looking at. Some people want to see upside. We're not going to get into that. You can put your own numbers, but it's really a function of silver price, what you believe the silver price to be and the gold price to be. But that project's very robust because it's a low capex, low OPEX, high grade project. What's very important about Boumadine, first of all, is jurisdiction. It's in what we qualify one of the best jurisdiction in the world right now for mining. So it's in Morocco, it's in the Atlas Mountain. As you know, we have a proven track record in the region. We've just built one mine on time and on budget, very low capex for the Zgounder mine. Well, we'll have the same here for the Boumadine mine. So it's proven track record, exceptional economics, low capital intensity when we compare it to the payback. It's a very large land position, and we're using a very small portion of the land in our resource calculation. Very important, we have the mining license. We are not waiting for the mining license, and the financing is spoken for. So all the boxes are ticked. We have the license, the mining license, which is the social license, the government license to operate. The financing is spoken for. The team just completed one construction. They'll do another one. It's a low risk, standalone model, and we will be producing 3 concentrate. Raphaël will explain this to you. And it's a very large land package. This is the land package. All we're using here is this portion, that main Boumadine trend. Everything else is untouched in the resource update. Of course, we've drilled 160,000 meters that we're going to add at the beginning of next year when we do the resource update. But the PA is only on one mining license, 32 square kilometers, and globally we're above 900 square kilometers. So you see how small it is to what we have and to all the ground and all the geophysical anomalies that we know we have. Well, you see them here. It's quite unique. So here, and again, why this is there's a major re-rating coming on the company. Low initial capex is a function of the risk profile. Very high capex are extremely high risk. They're complicated. They're very dangerous projects. This is a low initial capex project, making it a low risk project. Strong economics based on the production of 3 marketable concentrate, which is a simple flow sheet producing 3 concentrate. And the average payable of the gold equivalent concentrate, 73%, extremely high. Revenue driven by precious metal, gold and silver, some lead and zinc, so zinc and lead. So and this is the importance of the metal in the concentrates. Because it is high grade, we have the flexibility between open pit and underground mining, and we mine this the most efficient way and the most economical way possible. Very straightforward. It's not a science project. 3 conventional 3 concentrate flotation plant. So very straightforward how to operate this. And the last question people always ask, do you have the money to do this? And the answer is yes. Currently, our cash position is 114 million at the end of Q2, but as you know, it is increasing, and it will be higher than this at the end of Q3 because we are generating cash flow. So we are positively generating cash from Zgounder. We did raise money in June, so we have, and we did it and said that it was for Boumadine, which it is. Our financial partner, EBRD, is there. They gave us 100 million on Zgounder. They gave us a 25 million line of credit in the spring of this year. And they also made a commitment to be there as our financing partner on Boumadine. And they absolutely want to be there. And it's very good to have them there. So we are in a very good position. Beside them, all the Moroccan banks are also, willing to finance us. So it's a conglomerate of EBRD and the Canadian banks, or sorry, Moroccan banks. And we have off takers who are buying the concentrate, and they are willing to give us prepayment agreements on the offtake. So we're in a very, very good position to take this project to production. And let's go through the detail of the project with Raphaël. Raphaël is our VP operation. He is the one who did the Zgounder feasibility study. He ran the Zgounder development. He ran the Zgounder model. And today he did the commissioning. He did the ramp up, and he's now back in Montreal. He spent many months in Morocco. He's back in Montreal now to oversee the development of the Boumadine project, which is under his team. Now, Raphaël, I will pass it over to you now.
Thank you, Benoit. Thank you, Gorm. So I'll take a minute to introduce myself. I am Raphaël Beaudoin. I am in charge of operation at AYA. So I'm Vice President Operation, oversee project development, construction, operation of our various projects. So I'm very excited to be here today, Gorm, to talk to you a bit about the detail of this PEA that Benoit just outlined for us. So first of all, let's get into the MRE, the mineral resource estimate that was used for this project. After this, we'll have some detail on the mine plan, the mineral processing, the metallurgy, as well as the economics of the projects, more specifically the Capex, the OPEX, and what are the next steps for us for Boumadine. So like Benoit mentioned, one thing to keep in mind is this is the mineral resource that we published early in 2025, so up to date to late 2024, and we've been continuously drilling at Boumadine. We have an ongoing drilling campaign for 2025 that will end up at around 140,000 meters of drilling that has not been included into this PEA. So for this PEA, we have a mineral resource estimate of close to 35 million tons at a grade in gold equivalent over 4.5 gram per ton of gold equivalent, for a total resource estimate of above 5 million ounce of gold equivalent. And this is the basis for this PEA. We will continue to update the resource as we go, and we will continue to develop the project. Here, the technical team is right behind the geology. As soon as they have more discovery, we incorporate it into the model, and we continue to develop the project, now on the PA basis for today's presentation. Again, more on the resource. We've been expanding our resource over 100 million ounce of silver equivalent, and we increased the resource between 2024 MRE and 2025 MRE by above 29% in ounces. So let's dive into PEA for the mine plan. In this PEA, we have about 31 million ton of ore that we will mine through the life of mine. What's interesting is the first 2 years are exclusively open pit. So that delays the capital required for underground, and it allows us to start producing only with the open pit. It's about 2/3 open pit and 1/3 underground for the life of mine. We have a strike of about 5.7 kilometers, and the deep, to this day, they don't go deeper than 350 meters. We will have 6 open pit with good potential to merge some of these pits together and make them even bigger as we continue to do exploration on the property. We've been studying deeply into this PEA the mining method, whether we go open pit, whether we go underground, if we do long hole or cut and fill. And we found that the best ways to have about 2/3 in the open pit, 2/3 of the ton produced from the open pit, which allows a good flexibility of production. The average strip ratio for the open pit is about 21. Those are high-grade polymetallic and steep dipping veins for which we have geological continuity, and we have good visuals to follow the veins. As I mentioned, sequencing is open pit only throughout the life of mine, and after year 2, we start having underground ore coming from the underground. We have 6 open pit that gives good flexibility. And the first 5 years of the mine plan, the head grade to the mill will average 4.7 gram per ton of silver equivalent. And we've managed for this PA to include 77% on the mineral resource estimate into the mine plan. I like this slide a lot because it gives a good overview of the mines, and it also shows the flexibility that we'll have. So we have the north pit, we have 3 north pits, and we hope that as we continue the definition drilling and the exploration, we'll manage to coalesce some of these. And we have the center pit also. I want to stress that in the center pit and in the north pits, the mining infrastructure underground is independent of the open pit production. So that also gives us optionality and flexibility to make sure that our underground operations are disconnected from the north pits and the center pits. As we go south, we have two pit, what we call the South Pit 1 and South Pit 2, after which we will start the decline at the bottom of the pit to also save capital. And finally, extract the ore laying under the south pits. The processing profile focuses on the high grade for the first 5 years, after which we'll start processing lower grade stockpile, and we're quite confident that we'll find more ore, and those stockpiles won't be consumed, and we'll just continue to develop the mining project. Now, if we go a bit into the mineral processing, Boumadine is a well-known project. We've been working on it at AIA since 2018, and we've done 4 extensive metallurgical campaigns, which in my experience is quite robust, especially at this stage of the project. And what we find is fantastic recovery. We'll make a lead concentrate, a zinc concentrate, and a pyrite concentrate. And all of these 3 concentrate combined adds up to a total recovery for gold and silver above 96%, and a zinc recovery of 75%, and a lead recovery of 82%. And during the last 2 years especially, we've done lots of focus on the pyrite concentrate, which accounts for close to 50% of the value of the project. And we have shipped pyrite concentrate to at least 6 different smelters. We have interest from Europe to China, and more than that, not only they have tested our pyrite concentrate, they are very excited to have it because of its gold, of its silver, and also of its sulfur content, which is in high demand. We have received term sheets from 3 different traders of metal concentrate. So the metallurgy is sound. Every single campaign we've done has been with different samples that have been sampled across the mineral estimate resource, and we are quite confident with this. Now, from metallurgy, the next step is processing. Over the life of mine at Boumadine, we expect to process 3 million ton of ore per year, which gives us an average processing rate of 8,000 ton per day, for a total milling of 31 million ton for the PEA. The average production in gold equivalent for the life of mine sits at 328,000 ounces per year, with a focus on the first 5 years of the project, which we hope that we will continue to increase, of 400,000 ounces of gold equivalent per year. The plant will consist of a jaw crusher, a stockpile, a sag and ball mill, quite conventional, quite typical. The high sulfur content at Boumadine makes the ore hardness fairly low, which helps for the design, it helps for the energy consumption, and ultimately the cost. After which we'll have 3 distinct flotation circuits, one for lead, one for zinc, and one for pyrite flotation. Here we have a quick overview of the plant, in which we can see the SAG mill, the ball mill, the different flotation circuit, as well as some warehouse and flotation tanks for the pyrite cons. Now, I've mentioned this earlier in the metallurgy section. We are very excited of the market appetite for concentrate, and those are real numbers. We've consulted 3 different trading houses for concentrate, and those payables are all in. It includes the treatment, the refining charge, the deductible, and so on. So the total payable in gold equivalent sits at 73%, and we can see in this table the elements by elements, the payable per element, per metal, as well as the grade that we expect to produce in our concentrate. And we can see very good grade for the lead concentrate, especially, which contains a good lead and zinc content, and as well for pyrite that sits comfortably above any cutoff that we received for to market these concentrates. In the study, as you can imagine, it's 8,000 ton per day mining and processing operation, and which requires services such as water, power, logistics, tailing facilities. And we have good experience in Morocco from a Zgounder mine. We know good logistics companies. We need good engineering companies for the tailing facilities, and we work with sound, trusted partners of Morocco that helped us develop Zgounder, and they are very excited to work with us for our next project. The water supply, we did an extensive civil and hydrological study for water. We will pump water from 3 different relatively large cities around the mining project. We have about 100 kilometers of pipeline to do, 6 water pumping station, and these 3 cities, the treated wastewaters of these 3 cities alone is sufficient to provide all of the water we need at Boumadine. On top of that, we will continue to assess the water table in the region. We know there is water tables in the region. We need to pin it down further, and we also have several large water reservoirs from rainwater that are collected in the region for agriculture, for cities, and we will also evaluate the possibility to have access to these reservoirs as an extra contingency for water requirement. For power supply, we're privileged at Aya to have built a 90 kilometer, 60 kilovolt electrical line for Zgounder mine a couple of years ago. We were on time, we were on budget. At Zgounder, we built our 90 kilometer, 60 kilovolt power line for something around $8 million. So the cost attributed for the Boumadine PEA for electrical, we're really confident in it. We've done it in the past. It's copy-paste. I would even argue it's simpler because the terrain is more favorable and we now have experience for it. Again, logistics is important for Boumadine, and we have spent a lot of time and resource to have a sound study for the logistics, and we also cross-checked it with our historical cost of transport in the country. Morocco has fantastic infrastructures, and we can see in the slide we have 6 ports for which we can pick and choose to export or concentrate for Boumadine. We already have experience, especially with the Agadir port and the Casablanca port. And for this project, after we finalize our logistics study for this PEA, we have selected the Nador West port, which we believe is the best option for Boumadine, but there's also many viable options for the export of our concentrate. We are blessed with 3 national roads that go at Boumadine right now, from which we can export to Nador and to Agadir, which are both our preferred option. But we had to select one, and we decided to choose Nador for this project at this stage for various reasons. First of all is the cost, and second, we also have the optionality to extend a railroad in the future to further decrease the cost. The tailing facilities, we found a good emplacement for the tailings, which uses the natural topography of the terrain. So it's a valley that we will use for the deposition. It will be fully lined, fully constrained, downstream raises. I mean, state of the art as per our commitment to have safe tailing storage facility. And finally, for the infrastructure of the project, as I mentioned earlier, we'll have local roads, a processing plant, different workshops and warehouse, and all of this was incorporated into our initial capex in the financial model for this project. So if we dive in, the capex, like Benoit mentioned, is something not only we're proud of, not only is low, but it's something that we trust we can do. We know we can do. At Zgounder, we've built a quite similar project in many aspects on budget. And this is something that the whole team is very proud of. And I must stress that our whole construction team is still with us. They were relocated. Now they're focusing on this new project or helping us out as Zgounder. And when times to come to build this, we'll use the same local partners, the same engineering firm that helped us for Zgounder. And we have good relationship developed locally and also internationally to put this project forward. So the direct cost for this project, the initial capex, we have $54 million, which is used for the pre-stripping of the open pit. So once this $54 million is spent, we are producing in the open pit. After which we have the processing plant that is designed by Lycopodium, which is the same guys that designed our processing plant as Zgounder, for which we have huge success, and we are processing at 20-30% above nameplate at Zgounder, is the same guys that we use for our plant design at Boumadine. The shipping infrastructure at 11 million, which is also something we're quite comfortable. It's essentially the warehouse at the port for concentrate export. The electrical line, again, a copy paste of what we've done at Zgounder. The voltage is slightly higher because the power consumption will be higher, hence the higher cost than Zgounder, but we have high confidence in those numbers. And finally, we have the raw water supply to make sure we have the pumping stations and the pipeline required to feed the water of the mine. And finally, the tailing storage facility, again, same guys that helped us out as Zgounder, for which we're on time and on budget for tailing facility. Finally, the indirect costs, which are mostly related to the plant, the mobilization of the contractor, the manpower, and so forth, and a healthy 27% contingency at this stage of the project. We want to make sure we didn't forget anything, and at the PA level, we felt that it was safe and conservative to put a 27% contingency, which brings us to $446 million as initial investment for this project to get it producing to commercial production. And in sustaining throughout the life of mine, we have a bit more stripping in the other pits down the road, and we also have the underground infrastructure that we will do with our own cash flow that is not necessary to start the project. Operating costs are sound. We know mining costs in Morocco. We worked them out from first principle, and once we had all of our operating costs, we compared them with Zgounder, and they are very close, so we were very comfortable with that. And Boumadine is about 4 times the size of Zgounder in terms of tonnage and production, so we will benefit from an economy of scale, for which our global unit cost per ton will be lower. So on-site total operating costs we set at $72 per ton for the first 5 years, and it goes down over the life of mine. And we have product shipping of $39 per ton on a per ton milled basis. And this is a nuance that everybody must understand is we will produce 3 different concentrate that we will land transport and shipping of freight. So shipping and freight together, land and sea, account for about $70 per ton of concentrate ship. When you put it on a per ton mill basis, we lie at $38 per ton for a total cash cost per ton mill of $119. And once you add all of the sustaining capital, we're at $131 total per ton mill. And if we put it on a operating cost per ounce basis, it brings us to $1,021 per gold equivalent ounce produced over the life of mine, which is not only very competitive, but among the best projects that we see these days. Again, on a AISC cost curve, if we compare the Boumadine project to other operating assets right now, it sits among the lowest of the lowest. So this is why we like this project, and we're very happy with the work that both exploration and the technical team have been doing over the last 2, even 3 years. So the economic are robust. I won't repeat what Benoit described at the beginning of the presentation. I mean, we have a post-tax base case of $2 billion of free cash flow over the life of mine. Most of the revenues are derived from gold here, as 61% of the revenue is gold, 21% is silver, and about 18% is lead and zinc. And I quite like this waterfall. I think it really put the project in the light that we have $7 billion of revenue and after-tax free cash flow of $2 billion. And again, I repeat, this is the base case. So at $2,800 per ounce of gold and $30 per ounce of silver. And the best case is robust. The spot price is even better. And if we have a look at the downside, I think some people want to see that too. It just shows how robust the project is. Even if down the road the commodity price go down, we still sit at a payback post-tax of 3 years for Boumadine, and at a reasonable capex. It's a robust project. I mean, the downside is less than half of the current metal price, and even at half the current metal price, we have a payback of 3 years, which is, we believe, something should be highlighted. So same data, different visualization. We will have, over the first 3 years of the project, a post-tax free cash flow on the base case of around $300 million per year for the first 5 years. And as we continue developing the project, as we continue exploration, we hope we can sustain that down the road. Finally, we wanted to highlight all of the partners that have been working with us over the last 3 years for this PEA. And all these names speak for themselves. They are world-class consulting firms, both international and locally. For obvious reason, all of the good partners we can find in Morocco, we try to work with them. And over the last 5 years, especially with Zgounder, we developed very good relationship with trusted local firms that have even more of an insight for the in-country. And we've worked with both international and local firms based on their expertise. Now for the next step, we're all very excited to start working on the next step now that this PEA is behind us. We will work on two different tracks here. We have an extensive drilling program planned over the next couple of years at Boumadine, over 360,000 meters that we need to first increase the resource, also do some infill, and increase the conversion of the resource toward indicated and measured over the next couple of years. In parallel to that, we will continue advancing the project. So we'll have some pre-work for the feasibility study, some trade-offs, some metallurgy that will mostly focus on viability of the new zones that we keep finding, after which we'll do the feasibility study over the next couple of years. And then we'll put it in the hands of our construction team for the front-end engineering design, the long lead procurement, early work for construction in 2028 and 2029, for commissioning in 2030. So as we advance our aggressive drilling campaign, this will not stop the project. We will do the feasibility in parallel, and we'll have a good project, a good feasibility study to come out by the end of 2027. The environmental and social assessment is already ongoing. We've did a lot of work for this PA, and it will continue the same study throughout the feasibility study to make sure to have good data, to make sure the project is socially and environmentally sound. For this PEA, the flotation route demonstrated the best outcome for the project. We have strong recoveries, we have strong concentrate quality, and we have appetite in the market. I want to say again, we've been working with 3 different trading houses, and we've got term sheet for all of our production for all of these traders, and we went the extra mile to make sure that we would be confident for all concentrate, and we've sent samples on 6 different copper smelters, and there's appetite for all of them. The question is always, when can we get the product? Still, we also look further, and we've been looking into post treatment, even on site or in Morocco, if we can add value to the project. And we've done extensive roasting work over the last 2 years, working with Bigrim in China, as well as with Hatch and Hazen in North America for the smelting and the roasting of especially the roasting of our pyrite concentrate. And the results have been very good. We got up to 79% recovery for gold and 85% recovery for silver, everything combined. So after flotation, after roasting, after leaching, and on average, these recoveries, if we go on the roasting route, sit on average on 63% for gold and 80% on silver. We will continue to work the roasting route in the next years as we continue to develop the project in mind to commercialize all 3 of our concentrate, but we keep our options open, and we will continue to work on the roasting route over the next years. For this PEA, it's obvious to us that the best path forward at this stage is to just sell all 3 concentrate. It minimizes the capex and maximizes the revenues in time. For this PEA, we work with our current mineral resource estimate, and this estimate has only been on the main trend, and the main trend is only 2 permits out of many that we have. So the PEA is the first step. We've been working for this project for 3 years now. We've been drilling over 140 meters is not even included into this PEA. So we have significant exploration upside on the existing Boumadine deposits. It remains open in all directions, but especially on new targets that we have identified on our exploration permits that we will continue to work on the next years. Significant resource growth potential. There's future expansion opportunities. We designed the mill at 8,000 tons per day to have an 11-year life of mine, but we will not be shy to expand that in the future if we can expand the resource, as we believe we will. And finally, there's also optional product streams. If we look downstreams, whether it's a sulfuric acid production, whether it's expanding the mineral resource to other regional permits in Boumadine.
Okay, so thank you, Raphaël and Benoit, for the walkthrough. That's a good snapshot in time, obviously, and this, I think, is a very well done PEA. Most PEAs you see out there has not thought through these things as detailed as you have outlined today, so that's very good. And I think let's just start at the next steps, I think, because we don't have too much time, so I want to focus on that. First and foremost, you say feasibility study. Is it going to be a PFS first and then a feasibility study later, or will it be simply only a PFS or directly into feasibility? What's the idea?
Well, we're putting them together like side by side. This is a PEA, but with many chapters at the PFS level.
Yes.
But the resource are not. So because we didn't do the drilling. So as we do the drilling, which will take 18 months to do the drilling to be comfortable, we will do all the pre-construction and to lead into the feasibility study. So it's like a knitting. We go from PEA to kind of a short PFS, which won't be published. It'll be for us leading into a feasibility study.
Okay, so I think the crux of this is when do you think the effective cutoff would be for the final feasibility document that will be released end of 27?
The final cutoff?
Yeah,
be
so
end of 2020. That's right, the end of 2027 precisely.
that's when the
This is
feasibility is released, right? And then you
that's
have
when the
time to kind of
feasibility is released. That's right.
yeah. So you will provide a sort of a very up to speed mineral resource. So all of these 360,000 meters of drilling and the 140 currently excluding. So basically 500,000 meters of drilling would be on top of the existing resource.
We probably won't be done all the way to 360 because it takes time, but we'll
Yeah.
have enough to have reserves because the objective of the
Yes.
infill drilling is to move all of this into reserve. So the
Yes.
objective is to, have 3-4 years of reserve as we continue to drill. The beauty of this deposit is continuous. So it's not a question, is it there or not there? We do in the infill drilling is just to have a better geometry of the deposit, but it's very, very continuous. So the risk of the ore not being there is very small.
And not to mention, I sort of observed that the unit economics of underground and open pit are fairly similar, accounting for strip ratio. And obviously, this thing should be continuous to depth, and you haven't really explored to depth yet. So that's, or you have to some extent, but it's not in the resource. So big potential down there too.
Yeah,
Open.
that's correct. And we remain flexible on open pit and underground. This is something that we mentioned. Right now, we have a robust mine design with 6 different pits, with 5 different underground mines. That being said, this will obviously change. The more we drill, the more we find continuity, and we will adapt. The beauty is we know our mining costs, we know our open pit costs, we have good mining contractors, and at the end, we put all of this into an optimizer, and we decide what we're going to mine, whether it's open pit, whether it's underground.
But I am hearing that you guys will likely provide mineral resource updates, maybe one for Boumadine sometime next year. I would presume the cadence is held, so probably March or April or something like this as last year. And
Yeah,
then maybe you
well,
will,
definitely.
yeah.
Yeah, we will stop the drilling at the end of the year. We'll have 160,000 meters extra to add to the model, and we will do that and have a resource update by end of Q1, beginning of Q2.
Yeah, but sort of the final document that will lead into the construction decision, you would expect it, of course, to increase the confidence which is required to provide a reserve and so on, and also to provide more measured and indicated. But you would also probably expect it to expand the global mineral inventory outline in that study. Would that be a fair to say, or would that be unfair?
Actually, today we have enough mineral inventory to green light the construction. It's not in the proper category. So
Yes,
we
yes,
need to
yes,
move
of
it
course.
down from inferred to M&I to reserve. So we need
Yeah,
infill drilling. But even if we found nothing else, it would be enough. But you and I and us know that we've been putting out drill results at Boumadine for the past year
yeah.
of the drill program, and it's very well mineralized. So there we have more ounces to be added to the model, and that will be done in Q1 of this year of 2026.
I see. And the I guess the roster optionality. Could you just characterize a bit more? Do you hope to include that in the sort of that described in the feasibility study as an option or a sort of a step investment, or do you think that will become something that's more or explored once the mine is actually built?
Yeah, it's a stepped investment right now with the payouts that we're getting from the off takers and the smelters. The difference in the recovery is not big enough to say it's an easy investment decision. The
Yeah,
second part of it. So and that will become a state own or participation of the state and of other players in country. Their discussion right now in country maybe to not build a roaster but build a smelter because there's a new copper mine that would need a smelter. So there's a discussion, and if there is a smelter discussion, we bring our feed to the smelter. So it's kind of a moving target right now, and that's why we're so happy that the three concentrates are a standalone project
yeah.
and we can go ahead with that, and then the roaster slash smelter slash partners is going to be discussed in the months and maybe years to come.
I see. I see. So that's all well and good. And something that's sort of glossed over in a sense, but very important here is obviously your financing partner EBRD. Uh, they have indicated they want to support, but I have not seen any precise numbers, obviously, but now you have a capex estimate on a PEA level. They would require a feasibility, I presume, to give final commitments and so on. But one could
Yeah,
expect that they would provide the vast majority, if not all, of the debt for this development.
definitely. No. Their commitment to us is they will provide 100% of the debt capacity of the project. Absolutely.
Yeah. So this would be to the tune to 300 million US or something like this, quite likely. So
Yeah, 65% times 440 plus or
yeah.
minus. They are very comfortable with this. Very comfortable.
And the remaining piece is basically spoken for with equity currently, more or less. I mean, you have over 100 million right now, and we have how many quarters until we get construction decision? Basically, probably two
Eight,
full years.
eight, yeah.
So that's a lot of cash flow from Zgounder. I
Yes,
think.
yes, yes. We could have a cash balance by that time of 200 million probably. I mean, of course, money's going to go into the
Yeah.
drilling and the regional drilling at Boumadine because we have a lot of regional targets. So money's going to go there. But no, we'll be very, very liquid. And on top, the off-takers have already given us term sheets on prepayments. We haven't done the structure, but they want to do prepayments. So we have a lot of flexibility on the financing.
But you will probably spend, I mean, I would presume, sort of 70 million, at least 50 million, but probably more than that in drilling alone. Just 360. I mean, that amount of drilling is probably
Yeah.
50 million at least US, right?
Oh yeah, no. In the next 2 years on Boumadine, we have to spend 100 million. Let's say.
Yeah.
You
That's
know.
the cost to get to construction decision, basically.
Yeah, that's right.
Yeah. Perfect. And I think we should briefly, we have some time left, and I do want to ask about Zgounder since we're doing an update generally now as well. Just your comments on Q3, and then you could provide some color on the expectation for Q4 as well.
So look, Q3 is you saw the production numbers. It's almost 1.4 million.
Yeah.
The selling price was exceptional. So the margins, when we did the study on Zgounder, we were working with $12 margins. Now we're looking more in Q3 at $20 margin, and in Q4 we seem to be looking at $30 margins. So when you see these margins going from 12 to 20 to 30, obviously the cash flow is there. So it's that's where we're going. So Q3 is in line with our budget. We were expecting to be between 1.3, 1.4. That's exactly where we were. The throughput at the mine is excellent. The throughput at the plant is excellent. Actually, the plant exceeds our expectation. We're running 3,600, 3,700. Raphaël was there last week. He can tell you more. But and we're still tweaking on the grade of the open pit. That's where we're still not yet exactly where we want it to be, but we're getting there. And but at the end, look, it's 6 million next, 5 million this year, 6 million next year, and growing. Maybe Raphaël, you want to add? You were there last week.
Yeah, 2025 is a big year for us as Zgounder. We finalized the underground ramp up, which was a challenge last year. Now that's past us. The open pit, we have finalized a big pushback in Q3, and we're very well positioned to do our plan. So we unrolled the plan, and things are aligned. We have very pleasant surprise at the plant. The recovery holds well, and we now sit at 3,700 ton per day comfortably. We have the occasional day at 4,000 sometimes, and there's still room to stabilize and to continue to increase the milling. And at this price, it changes things on the cutoff, which also helps us on the stripping ratio. So the story at Zgounder is not done. Our open pit contractor is finalizing the mobilization of its permanent fleet to have for the super pit, and we're on time for that. The costs are as expected. The relationship with the contractor is good, and now we continue to stabilize production, and we will continue to ramp underground for the next 2 or 3 years. And we know we have some good grade as we get down in the mine. And we also have some extension in the northwest and the northeast, of the pit. So yeah, future is looking good at Zgounder.
So could we expect in Q4 the sort of the recoveries to remain stable from Q3?
Yeah, recoveries, that's past us. I mean, it's been four
Yes.
or 5 months now that we have recoveries above 90%. Sure, the more we push the plant, we need to adjust it to sustain the recoveries, but recoveries are sitting comfortably above 90%, and we don't see it going down.
And do you see mining rates being up Q3 to Q4? It was down slightly Q2 to Q3, but
Well, there's a nuance to that. Is Q3 we did in Q3 we did over 3 million tons of waste.
yes.
That was capitalized in stripping. So if we look at the total material moving rate, month after month, it's higher than the previous one. So our mining rate will be stable in Q4. This stripping is past us for 2025. The next push back is only in late 2026. And so ultimately, we're nearly done the mine ramp up. Now we need to continue focusing on grade control and fine tweak the mine plan for the life of mine.
And going into next year, I guess you would expect open pit rates to be above 2,000 tons per day, and then underground would scratch towards 1,500 or something like this. That's fair to say.
Yeah, yeah. The long term rate for underground is depending on the year, it's between 1,000 and 1,500. We're comfortably there already. And the open pit, I like to think of it more as a total material move per day. So for the open pit to produce comfortably above 2,000 ton of ore per day, we need to be at above 40,000 tons per day of total material move. And we're already there. We're already past that.
And again, we had a bit of a storm in a teacup, as they say, with this short thesis. I guess I'll let Benoit comment on that. But I did want to ask, because a part of this thesis, to my understanding, is criticizing the Zgounder resource. Are you guys going to provide a refreshed document or something to appease these critiques,
Yeah.
or and maybe just your general comments on this, Benoit? We haven't talked
Yes,
about
yes, yeah, absolutely. Well, that short attack was all garbage. I mean, there's no other word to say. It was a terrorist attack. Everything they were saying about me personally, about the company, about non-arm's length transaction was all false. They were trying to help a 25 million share short position to cover, which they have partially covered, but not totally covered. And we were due anyway to come up with a resource update at Zgounder. Things have changed, mining methods have changed, costs have changed, grade has changed. So yeah, they in December we will have a full review of the resource and the mining update and all of that. That will be. We were busy on Boumadine, as you can imagine. So the team was focused on Boumadine, but I would say starting next week, the team will go more towards Zgounder on the update.
Mhm.
Okay. I don't think we have too much more time now, so we'll have to end it there. But good update. I hope next time we'll be able to have David on as well and talk about the exploration developments, and I guess we
Yeah,
can dig into
well,
further detail on
that's yeah, yes, because there's a lot of great things coming through till year end and in Q1. So sometime in Q1, maybe at the resource update or when you want, we should have another call, and we'll bring David along as well to talk about the exploration upside at Boumadine and at Zgounder, both.
Yeah, he is a fan favorite, so people will look forward to that, I think.
Yeah, perfect, great pleasure.